Welcome back to Investing Talk Podcast.
Today we're looking at the metals company.
As usual, before we start, subscribe, like, and comment to this video to support the show.
So, I have to say, the premise of this company sounds like it was ripped straight out of a science fiction novel.
It really does. I mean, we are talking about a pre-revenue exploration firm whose entire business model is essentially sending heavy machinery to the bottom of the ocean floor.
Right.
Just to vacuum up these things called polymetallic nodules.
Yeah, and I know what you as a listener might be thinking right now. Why should you care about a company that is currently making absolutely zero money?
Exactly.
Well, it's because the metals company is sitting right at the intersection of this unavoidable, massive geopolitical shift. We are right in the middle of a global race to secure critical metals.
We're talking nickel, copper, cobalt, manganese.
Yep, the exact fundamental building blocks for electric vehicles, renewable energy infrastructure, and advanced national defense systems.
And the science behind these nodules alone is just fascinating. They're basically these rock formations, roughly the size of a potato, that just sit unattached on the abyssal plain of the ocean.
They don't even have to dig for them.
Right, they just sit there. They take millions of years to form, literally absorbing metals directly from the seawater. But the real key to the economic equation here is securing these materials without relying on foreign adversaries.
Because right now, the supply chain for these critical minerals is heavily monopolized.
It is, which creates this unprecedented vulnerability for Western manufacturing. So you have this company stepping up saying, hey, let's bypass traditional land-based mining entirely. Let's just harvest these metals from the ocean floor.
It's an incredibly ambitious goal. But before we get swept away by the futuristic narrative here, let's unpack the fundamentals and look at the actual numbers because, as you can imagine, the reality of operating miles underwater is staggeringly expensive.
Oh, absolutely.
You're dealing with an environment that is, frankly, less forgiving than outer space.
I was looking at their balance sheet from the recent filings, and the cash burn absolutely floored me. I mean, let's just lay out the hard reality for you. The company currently generates zero revenue. None at all. Meanwhile, their most recent quarterly net loss came in at an eye-watering $184.4 million.
Which breaks down to about a 46-cent loss per share.
Yeah. And if you are an investor hoping for a quick, painless turnaround here, the forward projections for 2026 look equally brutal. They're forecasting continued losses of approximately $295.5 million.
A massive number. But the sheer scale of that capital requirement starts to make sense when you look at where the money is actually going.
Right, it's not cheap gear.
Exactly. You aren't just buying off-the-shelf mining excavators from a local dealership. You are engineering highly specialized robotics that have to survive immense hydrostatic pressure.
Yeah.
To put that in perspective for you, at 4,000 meters deep, the water pressure is roughly equivalent to having an elephant standing on your thumb.
Wow.
Yeah. So building machines that can move around, collect these nodules without instantly destroying themselves, and then pump a slurry of rocks and water miles up a riser pipe to a sofa ship.
It requires bleeding-edge engineering.
Precisely. That $295.5 million projected loss is just the astronomical price of entry for pioneering an entirely new extractive industry.
Which brings us to a very harsh reality regarding their financial health.
Right.
Because with zero revenue, negative free cash flow, and obviously no dividends or stock buybacks to support the share price, the company survives purely on equity raises.
They're constantly going back to the well.
They are essentially building a multi-billion-dollar space station without knowing for sure if they're even legally allowed to launch the rocket. They have to keep returning to the open market, asking for more capital just to keep the lights on and the environmental research going.
And that leads to the inevitable painful consequence for the retail investor: dilution. Because they aren't generating cash internally, issuing new equity is their only lifeline.
And I want to make sure we clearly define what that means for your portfolio. This dependency on equity raises means ongoing shareholder dilution. And right now, that dilution is happening below the net asset value per share.
Yeah, that's the painful part.
Think of it like a pizza. Every time the company issues new shares to fund their operations, they are cutting that pizza into more and more slices.
The pie isn't getting any bigger.
Exactly. Even though the overall size of the pie hasn't changed, your individual slice gets smaller and less filling. You are essentially paying out of your own pocket for their day-to-day survival while waiting in the dark for commercial production to finally begin.
It is an undeniably bleak side of the ledger. But if we connect this back to the bigger picture, we really have to look at their competitive moat.
Right.
The long-term upside is the exact reason those equity raises somehow keep getting funded by early believers. Their primary advantage is a pioneering first-mover position in the Clarion-Clipperton zone.
The CC's.
Right. This is an enormous swath of the Pacific Ocean floor, situated roughly between Hawaii and Mexico, that is practically paved with these polymetallic nodules. And they just scored a monumental, potentially game-changing regulatory win.
The NOAA determination.
Yes. Following compliance determinations with NOAA, the National Oceanic and Atmospheric Administration, they have officially expanded their claims to a staggering 65,000 square kilometers.
And to put that scale into perspective for you, 65,000 square kilometers is roughly the size of the entire state of West Virginia.
It's massive.
It is an absolutely colossal underwater territory.
And that territory represents a macroeconomic moat that is hard to overstate. Because they have U.S. government backing through this specific regulatory process, they are positioning themselves as a domestic, low-impact alternative to terrestrial supply squeezes.
Because right now, China heavily dominates the rare earth and critical minerals market.
Completely. They control the complex processing facilities, and they control a vast amount of the raw extraction globally.
So the metals company is offering a direct, localized workaround to that geopolitical bottleneck.
Huh.
By harvesting the ocean floor in international waters under NOAA compliance, they circumvent foreign dominance entirely.
Exactly.
So if the financials are bleeding but the regulations are clearing, how is Wall Street actually reacting to this tug of war? Pivoting to the charts and price action, you can actually see the market actively pricing in that new macroeconomic moat.
Yeah, the charts have been interesting.
On March 9, 2026, we saw some undeniably bullish price action. Shares experienced a significant breakout, and it was directly triggered by that NOAA compliance determination hitting the newswires.
That specific date is such a crucial pivot point. March 9 wasn't just some random retail fluctuation or a temporary social media hype cycle.
Yeah.
It was a fundamental re-rating of the stock's underlying risk profile based on tangible regulatory progress.
And what's vital for you to understand as an investor looking at the technicals is how this regulatory win established strong psychological support above the stock's recent, honestly rather depressing lows.
Right.
When a pre-revenue exploration company gets a formal stamp of approval from a major federal agency like NOAA, it fundamentally changes the conversation in boardroom meetings. It opens the door for higher highs because the project scope is officially expanding on paper.
The market suddenly sees a viable, legally protected path forward. It's not just a theoretical pipe dream anymore.
Exactly. And if you look at the momentum and market flow, what you'll find fascinating is that this upward trajectory is driven strictly by those regulatory victories.
We aren't seeing the massive, unexplained volume spikes or the unusual, chaotic options flow that usually accompanies speculative small-cap pumps.
Right, there's no meme stock energy here.
No. This is methodical, institutional-style buying based on clearing real-world compliance milestones.
That is a crucial distinction. It's news-driven momentum, but the news is highly substantive. And we also have to zoom out and factor in the broader sector tailwinds pushing from behind. Look at the geopolitical tensions dominating the headlines recently.
Like the conflicts involving the U.S., Israel, and Iran.
Exactly. Whenever global stability is threatened, traditional land-based supply chains suddenly look incredibly fragile. That fragility has pushed the broader rare earth and critical mineral sector higher across the board.
And the metals company is being indirectly lifted by that rising tide.
Because they represent a secure, alternative supply chain that is totally isolated from terrestrial war zones.
Which is a huge selling point. So let's shift over to market sentiment and what the street is saying, because the narrative surrounding this stock is just as volatile as the broader geopolitical landscape we just discussed.
Oh, for sure. Looking at the quantitative scoring of recent media coverage, the overall mood right now is mildly bullish.
Wildly.
Yes, mildly. But let's be clear, it is heavily, almost entirely anchored by that March 9 NOAA compliance and the expansion in the Clarion-Clipperton zone. Without that specific piece of good news, the sentiment would likely be much darker given the aggressive cash burn we outlined earlier.
The media narratives are a perfect study in extremes here. You have this incredible dichotomy playing out in real time. On one side, you have cautious, neutral takes running headlines like, could sis you up for life or go to zero.
which, to be completely fair to the journalists, is an incredibly accurate summary of a pre-revenue exploration stock operating at the bottom of the ocean.
It is the literal definition of a binary outcome.
I really love that headline because it refuses to pull punches.
Yeah.
But what about the other side of the spectrum? Because the financial media loves a moonshot story.
They do.
And mining the bottom of the ocean to defeat a foreign monopoly is a narrative that practically writes itself.
Exactly. And that is why you have hyper-bullish labels out there calling it a small-cap gem with explosive 10x to 100x upside potential.
Yeah, you see those everywhere.
They also recently got a substantial visibility boost from a red chip interview on Bloomberg TV. That kind of high-profile placement puts their ambitious story directly in front of a much broader, deep-pocketed retail and institutional audience, people who might not normally look at deep-sea mining.
Well, here is where I had to throw some cold water on the parade.
Okay.
And where we need to look past the media hype to examine analyst actions versus actual institutional flow.
Yeah, real numbers.
Right. If you look at the consensus ratings from Wall Street analysts, the metals company sits at a buy to strong buy rating. In fact, fully half of the analysts covering the stock rate, it's a strong buy.
Wow.
Their price targets range from $9.42, which implies a 64% upside from current levels, all the way up to $11.38.
Those are exceptionally aggressive price targets for a company burning hundreds of millions of dollars a year with no product to sell yet.
Exactly. And this is where the skepticism has to kick in for you as an investor. Despite these sky-high price targets and glowing strong buy ratings, there's a glaring disconnect in the actual money flow.
The insiders aren't buying.
No. We track something called Form 4s. These are documents executives must file when they buy or sell shares of their own company. Right now, there is zero recent insider cluster buying. We aren't seeing the executives aggressively loading up on their own stock. And furthermore, there is no major institutional accumulation showing up in the 13F filings.
For those listening, a 13F is a quarterly report filed by institutional investment managers with over $100 million in qualifying assets.
Exactly. The big funds aren't backing up the truck to buy shares. So you have analysts telling retail investors it's a strong buy, but the insiders and the smart money institutions are sitting squarely on their hands. That is a glaring red flag that demands severe caution.
It really is. And that disconnect raises a vital question. What are the institutions seeing on the horizon that makes them so hesitant, despite the undeniable regulatory wins?
To answer that, we need to execute a deep analysis into the bear case and the speculative hurdles here, because the risks associated with this venture are just as monumental as the potential rewards.
The most immediate pressing risk number one, is the timeline to revenue. We've touched on the pre-production timeline, but we really need to emphasize how financially painful this upcoming phase will be.
Yeah, it's not going to be easy.
Commercial recovery and sale of these nodules is still years away from becoming a reality.
So what does this actually mean for you if you buy in today? It means you are signing up to endure years of amplified, unavoidable losses.
Years!
You're signing up for zero cash flow. And, tying back to our earlier point, you are signing up for guaranteed shareholder dilution. The company has to survive until they can actually bring those metals to the surface and sell them. And you are the one footing the bill for their survival in the meantime.
And if the operational timeline gets delayed by even a year or two, which is incredibly common in frontier industries,
Very common.
the resulting dilution could entirely wipe out the value of the shares you hold today.
And a timeline delay isn't just a possibility. It is highly probable when you look at risk number 2, which is regulatory and environmental headwinds. Yes, the NOAA compliance determination was an enormous hurdle successfully cleared. It was a major victory for their domestic narrative.
But the overarching war is far from won. The ocean floor is entirely new territory, both legally and environmentally.
We have to acknowledge the fierce, highly organized environmental opposition to seabed mining. You have major global NGOs, prominent marine biologists, and climate activists sounding a very loud alarm.
Because the ecological impacts of harvesting the ocean floor are heavily contested and really poorly understood.
We barely comprehend the delicate deep-sea ecosystems functioning in the Clarion-Clipperton Zone.
Right. Harvesting these nodules involves deploying giant tracked machines that kick up immense sediment plumes, create profound noise pollution in a normally silent environment, and potentially destroy benthic habitats that take millennia to form.
There's a very real wry irony here. We're talking about potentially destroying the pristine ocean floor in order to build the batteries needed to save the planet from climate change.
Which means there is a constant looming threat of abrupt regulatory roadblocks or catastrophic public relations disasters. Even with NOAA on their side for this specific territorial claim, international bodies like the International Seabed Authority, the ISA, are still in the process of writing the overarching rules for global exploitation.
Right, the ISA hasn't finalized anything.
Exactly. If public sentiment turns aggressively against deep-sea mining, or if a newly funded environmental study demonstrates irreversible, catastrophic impact to the marine food web, the regulatory doors could slam shut just as quickly as they opened.
Bringing this all together for our final verdict, we are forced to weigh an incredible macroeconomic necessity against severe financial and environmental realities.
When we aggregate the quantitative data, the cash burn, and the recent regulatory catalysts, our final bullish score for the metals company comes in at a 7 out of 10.
A 7 out of 10. That is a score that clearly respects the momentum of the NOAA win, but leaves plenty of breathing room for the undeniable, potentially company-ending risks.
Exactly. The multi-year investment thesis here is that the metals company is the ultimate asymmetric, high-risk, high-reward bet. You have to contextualize this within the looming Pentagon 2027 ban on Chinese rare earth metals.
That's the real driver here.
Yes. That impending legislation creates a desperate, federally mandated urgency for a U.S.-backed supplier. By 2027, the Department of Defense will be legally prohibited from relying on Chinese supply chains for certain critical minerals used in national security applications.
And permitting a new land-based mine in the United States can take a decade or more.
Right. The deep sea might be their only viable shortcut.
So, while the financial losses are incredibly steep right now, and the incoming dilution is going to be painful for early adopters, the regulatory de-risking of a multi-billion-ton resource offers a genuinely rare opportunity.
And it is a colossal, if they can successfully navigate the engineering nightmares and reach commercial production, the returns could be exponential.
Because they'll be selling into a global market that has a federally mandated, price-insensitive demand for their exact product.
It truly is a binary outcome. It either goes to zero, collapsing under the crushing weight of its own capital requirements and fierce environmental opposition, or it succeeds and becomes an absolute cornerstone of the 21st century supply chain.
Which leaves us with a fascinating philosophical paradox to chew on. As the world races toward an electrified high-tech future, driven by a noble desire to be greener and more sustainable, will the hidden environmental cost of not mining the deep sea ultimately force our hand?
It's a tough question.
If we refuse to embrace the unknown risks of the ocean floor out of an abundance of caution, are we simply choosing to rely on the known, highly destructive, carbon-intensive practices of traditional land mining, which just so happen to be controlled by our geopolitical adversaries?
It is a complex trade-off that global society is going to have to navigate very soon. It's really the ultimate ethical and economic balancing act of our generation.
It really is. And that's all the time we have for today. As usual, before we sign off, subscribe, like, and comment to this video to support the show. We'll see you next time.